friends, this is Dr. Vinayak Pagedar and I welcome you to another discussion on direct taxes. Today we will be discussing section 54, that is capital gains in relation to a house property and how you can claim the exemption. We'll be discussing the basics of section 54 and also the amendment, very important amendment, which is introduced by the Finance Act 2019, thereby amending the effect of section 54. Okay, now let us first discuss the basics of how 54 operates, why it operates. This is an assessee, and the assessee has sold a residential house property. The assessee has sold a residential house property. Obviously, we know that house property is a capital asset, and if you sell a residential house property, there's bound to be some capital gains. Now, assuming that this house property is long term, there is some long term capital gains. And the moment there's some long term capital gains, it may be subject to long term capital gains tax. But if you wish to avoid the long-term capital gains tax, that is claim the exemption, you must invest this long-term capital gains in a new residential house property. So the moment you invest that capital gains in a new residential house property, you can claim the exemption under section 54. Obviously, by now you've understood that the aim of section 54 is to protect an assessee who may be shifting a house property. For example, I may shift a house property due to various reasons. I may change my location. I stay in Bombay, maybe I come to Calicut. So I sell the house property at Bombay and I invest in a residential house property at Calicut. And in such a situation, I should not be burdened by the impact of capital gains tax. So in order to protect a person who shifts a residential house property, this section was basically introduced. Now we'll come to the main provision, and there are 3 points which you see on your screen. Always think of it in that order. Number 1, who should be the assessee? Number 2, what is the capital asset transferred? And number 3, what is the period of holding of that capital asset transferred? If you wish to claim exemption under section 54, you have to be an individual or an HUF. Only an individual or HUF can claim this exemption. This means that if you are a company, a firm, an AOP, a political party, a trust, so on and so forth, you cannot get the benefit of this section. So this section is available only to an assessee who's an individual or an HUF. Now, such individual or HUF has transferred a residential house property. There's a transfer of a residential house property. Very important, the word is residential and not commercial. So, if you're using a property for your business and profession, you cannot claim this section for such a property. So, my friends, an individual or HUF has transferred a residential house property, and such house property, the house property which is sold, as we have seen in our example, has to be a long-term capital asset. Let us say I am an individual. I am an individual, obviously, and let us say I sell my residential house at Mumbai, and that residential house was short-term in nature. The period of holding was short-term, then I am not eligible for this section. So the conditions which you see on your screen, all the 3 conditions should be satisfied. The assessee should be an individual or HUF. Number 2, he has transferred a capital asset being a residential house property, and the period of holding of the transferred capital asset was long term. So when these 3 conditions are satisfied, now we move into the remaining part. Now, just if you transfer a residential house property, you very well know that you cannot get the exemption. The exemption is not obtained by just transferring a residential house property. The residential house property is transferred, there's some capital gain generated, and that has to be invested in a new capital asset, and the new capital asset should also be a residential house property. So today if I transfer a residential house property, as we had seen in the example, and invest in a new residential house property, I get the exemption of section 54. Remember, this new residential house property in which I have invested to claim the exemption must be in India. So if I sell my property at Mumbai and I invest in a new residential house property at Calicut, I can claim this exemption. But if I sell my residential house property at Mumbai and invest in a new residential house property at New York, then I cannot claim this exemption, because the condition is very clear: the investment asset must be located in India. The exemption is very simple: the amount which you have invested in the new asset, or the gross long-term capital gain, whichever is lower, is the exemption. So at any point of time, if your investment is more than the long-term capital gain, then the exemption will be restricted to the amount of long-term capital gain. In simple words, amount invested in the new asset or the gross long-term capital gain arising from the transfer, whichever is lower. And the time limit for investment is, if you are purchasing, then the purchase has to be made within 1 year before or within 2 years after the date of transfer. And if you are constructing, the construction has to be done within 3 years from the date of transfer. So there's the time limit for investment is very clear. It is within 1 year before or within 2 years after the date of transfer in case of purchase. And if you are constructing, then the new asset should be created by way of construction within 3 years of the date of transfer. The investment has to be made in the time frame. If not, you will not get the exemption. Okay. Now let's proceed and analyze this 1 year, 2 year, 3 year which we've spoken of. On your screen, there's a house property. This residential house property has been transferred. Let us say today is the date of transfer. If today is the date of transfer, then I get a time limit of 2 years. 2 years from today. Within 2 years from today, I should purchase a new residential house property. So I've got a time limit up to 2 years from the date of transfer. Now you will say, what if I make the investment after 2 years? Then my friends, if you make the investment after 2 years and it's a purchase, then you will not get the exemption, because you have gone beyond the time limit. The time limit for purchase is within 2 years from the date of transfer. Also, we've seen a clause which says that within 1 year before the date of transfer, we can purchase the house too. Now, this part is confusing for many students, that how do you get that 1 year before the date of transfer? See, there are two ways in which I can purchase the new house. Step 1, sell the old, I'll get the capital gains, then I invest it in the new house. 2 years for that. But there's also a possibility that I may first buy the new house and then sell the old house. In that case, I get a time limit of 1 year. So today, if I purchased the new house already, then my old house should be sold within a period of 1 year from today. And when we write it, we say within 1 year before the date of transfer. This is how it comes. Okay. What if still earlier? That means, what if there's a period more than 1 year prior? Then in that case, obviously, you're not going to get the exemption. The purchase should be made within 1 year before or within 2 years after the date of transfer to claim the exemption. Construction takes longer. So in case you are constructing a house property, then you get a time limit of 3 years from the date of transfer. So your new house should be constructed and the investment has to be made within a period of 3 years to claim the exemption. You'll say, sir, what if we've constructed beyond the 3 years time limit? then my friends, whatever investment goes in such construction, that will not be eligible for the exemption. Okay, so that was your 1 year before, 2 years after, and 3 years after, the 1, 2, 3 time limit. Now I'm assuming that you know the basics of section 54, so I've gone through it a bit rapidly, and we'll be now discussing the amendment introduced by the Finance Act, and also we'll take an illustration connected to the same. So, my dear friends, the amendment made by the Finance Act 2019. Now, prior to this amendment, the investment could only be made in one residential house property in India. That means if I sell my house at Bombay and I want to protect myself from the hit of capital gains, then remember, I have to make the investment only in one residential house property. You'll say, sir, what if we invested in two? Then my friends, earlier you could not invest in two because the Act spoke of giving exemption only for one residential house property. So if I were to invest in two earlier, if I were to invest in two residential house property, then I could only claim the exemption for the cost of any one out of those two. But if you look at the past 2 years, there's a bad slump in the real estate sector. And in order to protect the real estate sector and also to give an encouragement to the assessee, now in certain cases, you are allowed to invest in two residential house properties also. So let's see this amendment properly. Now, we've sold a house property. Let's say at Mumbai, I've sold my house property and there is some long-term capital gains. Now, if the long-term capital gains is up to 2 crores, then you can make this investment. This long-term capital gains is up to 2 crores, then such long-term capital gain can be distributed in two residential house properties. So you can invest in two new residential house properties. Obviously, it is not mandatory. It is an option given to you that if you want, you could create your second house too. So you can invest in two new residential house properties if your long-term capital gain, it does not exceed 2 crores. This is basically to give an incentive to the common man to create his second house. However, if your long-term capital gains exceeds 2 crores, these are the big assessees, the high net worth assessees or the assessees who have got money, then they can afford to pay the tax. If they want to claim the exemption, they have option, or rather no option, they can invest only in one residential house property. So common men are those whose capital gain is less than 2 crores and such people can invest in two residential house properties. There's an option given to them. But the big shots whose capital gain is more than 2 crores, then such people are not given the benefit of two house properties. They can invest only in one residential house property. Now, for the common man, the two house properties exemption, the investment in two house properties comes with a rider. And the rider is, my friends, that once you have taken the benefit by investing in two residential house properties, then for any other year, for this year or any other year, you can never ever claim this benefit again. That means to invest in two house properties is a one-time option in the life of the assessee, and if he has availed that option, he can never ever claim this option under this section ever in his life. Correct? So the chart is very simple. It gives you all the details, and if you've understood this, which I believe you have, now we can go to an illustration. So there's a very simple illustration. We'll read it first. Mr. X is an assessee. He purchased a house. We assume it is a residential house and the house was for 50 lakh rupees in the year 1213. in 2012-13, he purchased a residential house property for 50 lakhs. In the current year, 1920, this residential house property was sold for 1.5 crores. As you know, 1.5 crores is the sale price. It is the full value of consideration. The brokerage on the sale transaction, very clearly we have said the brokerage on sale transaction was 1 lakh rupees. There was no brokerage on the purchase, but when we sold the property in the current year, our broker took 1 lakh rupees from us. Now what Mr. X has done is, he has made an investment in 2 residential house properties. First, he invests 30 lakhs in a house property at Mumbai on 1st June 2020, and another 35 lakhs he invests it in a flat in Calicut on 1st of September 2020. So my friends, what Mr. X has done is, he has invested this capital gain in 2 residential house properties, and we'll have to see whether he can actually claim the exemption for both. Okay, so we are computing the capital gains, and let's see how the section 54 exemption is claimed. Step by step. First point, we give the heading computation of capital gains. In the exam, you'll have to write the name of the assessee, the PY, the AY. Here I am skipping it because you understand these are basics. So we start with the computation of capital gains. Now all of you know how to do it. The full value of consideration minus the transfer expenses. We arrive at the net consideration, and we know that our house property which is sold, the house property which is sold in 1920 was purchased in 1213. So the period of holding is more than 2 years, and therefore this house property is long term. Whenever a capital asset is long term, you get the benefit of indexation. So step by step, let us start. The full value of consideration is 1 crore 50 lakhs. So we've got 150 lakhs sale price. That's the full value of consideration. And the broker had charged us 1 lakh rupees, if you remember. So that 1 lakh is the transfer expense. Obviously from 1 crore 50 lakhs, if we subtract that 1 lakh, we've got 1 crore 49 lakhs, which is the net consideration. And now what do we do? From the net consideration, we will subtract the indexed cost of acquisition. Very simple formula. The second proviso to section 48, take the cost of acquisition, multiply the index of the transfer year and divide it by the index of the acquisition or purchase year. Okay, let's see. So what is the cost of acquisition of this property? Very clear, it is 50 lakhs. Multiply by the index of the transfer year, that is 289, and the purchase year was 1213. So if you look up the indexation tables, you will get 200 as the index of 1213. So 50 lakhs into 289 divided by 200, you'll get 72 lakh 25,000 as the indexed cost of acquisition. Correct? So on the calculator, if you work it out, you should get 72 lakhs 25 as the index cost of acquisition. Net consideration minus the index cost of acquisition. Now you get the gross long-term capital gains at 76 lakhs 75,000. At this point of time, my friends, we have to look into whether section 54 exemption can be claimed. The assessee is Mr. X. He's an individual. He has transferred a residential house property. The period of holding of the transferred asset was long term, and he has made an investment also in residential house properties. So it's very clear that he can get the exemption of section 54. But now the question is, can he get the exemption for both the properties, the Mumbai property as well as the Calicut property, or will the exemption be restricted to one property? Now here, if you've observed the earlier discussion and understood it properly, look at the gross long-term capital gains. this gross long-term capital gains is less than 2 crores. Correct? 76 lakhs 75,000 does not exceed 2 crores, and therefore Mr. X has the option, it is not mandatory, he has the option to make investment in 2 residential house properties, which the question says he has done. So, since the capital gain has not exceeded 2 crores, the exemption under section 54 will be the cost of the Mumbai property plus the cost of the Calicut property. So, investment of 30 lakhs plus 35 lakhs, which comes to 65 lakhs, is the total exemption under section 54. What if this capital gain was more than 2 crores? Then only one property you can invest in. Investment in both the properties would not be possible. So from 76 lakhs 75,000, if you subtract 65 lakhs, you get the taxable long-term capital gain at 11 lakh 75,000. Correct? So this was your calculation. Now, is there a catch to this calculation? Yes, there is certainly a catch. If Mr. X is your client, you will have to inform Mr. X that, look, Mr. X, you've taken the option of investing in 2 residential house properties for claiming section 54 exemption, and therefore in no future year will you ever be able to invest once again in 2 residential house properties under this section. The doors of the option are now closed for you. So if this question came into the exam, you would have to write a note by saying that, look, since the assessee has exercised the option of investing in 2 residential house properties in AY 2021, he will never ever be able to exercise this option again for the same year or any future AY under section 54. So I hope you've understood this. This was a quick rapid revision of the amendment, and I'll be putting such amendments up time and again for you people to revise. So all the best and see you soon.